Juerg, a happy year of the tiger to you. Thank you so much for joining us this morning on the Bloomberg Edge. So this is interesting, how you're kind of backtracking your views on gold. Now, two of the biggest catalysts for the rally in precious metals have been that weak dollar and signs of an economic recovery. And both those factors right now taking a hit, especially the U.S. dollar rising at this point, and the economic recovery not so stable considering the effects that we're seeing in the Eurozone.
I think, if you look at precious metal, it's not really an issue of economic recovery. It's an issue of monetization and government involvement into an economy and situation of fragile debt markets, so basically bad credit. So we are still bullish gold. We are very bullish gold. The issue we are more bullish silver is the fact that we have no central banks overhang and that the ratio of silver versus gold has been going to extreme levels. I mean, if you look at the 70s, the ratio was about 15-1. And if you look basically early last decade, we've been at about 50-1. Today we are 70-1. And I think that's to a large extent overstretched. So we're looking for the ratio to come back somewhere to the means between 15 and 50-1. And that means we have considerably more upside in silver than in gold in the precious metal universe.
Yeah, Juerg, it looks like silver is trading at maybe $15 and change. In fact, you think silver can gain as much as to $25, which is a $10 rise from here. That's a huge upside potential for this commodity.
Yeah, but it's a tiny commodity as such, and it has extreme imbalances in the demand-supply picture, and it's got a huge derivative book. And we believe that this derivative book on the silver side will sooner or later start to unwind due to limitation on delivery, and that's going to mean significantly higher prices.
Okay, so the theory goes you can make more money in silver when the market is on the rise, but no overhang of leased silver in central bank vaults. But can you also lose more money when silver falls, though?
I think in general what you start seeing with commodities is once they're getting close to production costs, your bottom is in commodities, and that's true for precious metals too. So if you look at the production costs in both metals, they are maybe 20% below of where we have today the market. So a 20% correction capability and the underlying versus basically a significantly upside, which is a multiple of your downside risk, is certainly worthwhile playing.
Okay, let me just ask you about gold, because I found it interesting that you're backtracking from your previous prediction that gold would go as high as $2,500 an ounce. Now you're looking at maybe $1,350 to $1,650 this year. Why the change of heart?
No, I haven't really backtracked as such. I think, by about 2011-12, gold will be at least twice as high of where we are today. So it's a timing issue if you look end of the year or if you look at 18 months period. So I haven't backtracked on the issue. The first resistance which we have in the gold market is somewhere between 1350 and 1750, and I think that's the next test, and we're going to consolidate and then probably will run a bit more. So we are still bullish gold. We are very bullish gold, despite a lot of negative news which are coming out from people like the World Gold Council, which keeps telling people that China will not buy gold, and if not China, who will buy gold? We had Soros saying gold is in a bubble, but he didn't really mean that. He said it's going to end up in a bubble, probably. So people thought he was selling gold, and next week the announcement comes out he buys gold. So we have a lot of this information in the market. But the basic demand-supply imbalances and the reason why people own gold has basically been maintained.
Okay, let me just ask you something about, how we started this segment talking about Credit Suisse's prediction that gold prices will fall in the month of March. In fact, historically, gold prices dropped the most during the month of March because of lower jewelry purchases and also higher interest rates to come. What do you think?
I mean, your interest rates are still rock bottom, so they are neglectable, right? It doesn't really make any difference. Months of March, sure, we might get a small hip, or maybe it's February or April. I think the month is not really relevant. You buy gold for the next 2 or 3 years as a strategic investment and not as a monthly play, because your trading costs are too high. And thirdly, when has Credit Suisse ever been bullish on gold? How much gold exposure do they have in their accounts? What do they know about gold? I mean, they haven't been in the market since 256, and now they are all of a sudden bearish.